Welcome to vTalkInsight, Risk Sentiment Daily for February 2nd, 2026. Markets are grappling with a more hawkish Federal Reserve backdrop, rising inflation concerns, and fresh political risk, even as powerful AI and European growth stories keep risk appetite alive. Let us start with how overall risk sentiment is setting up across assets. Across global markets, the tone has shifted to cautiously risk-off, with equities slipping and volatility edging higher after a strong run earlier in the month. Recent sessions still showed solid gains for January, including meaningful strength in small caps, but the latest price action now reflects more de-risking and profit-taking rather than broad risk-seeking. Earlier in the week, risk sentiment was growth-biased, anchored by an AI-driven capex boom, resilient macro data, and strong earnings from select sectors. That backdrop has not disappeared, but it is now increasingly wrapped in hedges and tactical defensiveness as investors respond to a hawkish shift in Fed expectations, tighter financial conditions, and sharp cross-asset moves in commodities and precious metals. Price action points to two-way markets. Risk assets remain engaged, yet flows are rotating away from crowded trades, such as high-multiple tech and speculative metals, toward more value-oriented sectors and regions. At the same time, concerns over Fed leadership, inflation data, and political headlines are raising event risk, prompting investors to trim exposure at the margin and lean more on cash, quality balance sheets, and shorter duration assets. A key bearish driver today is hawkish Fed leadership and a weaker Fed put, centered on the nomination of Kevin Warsh as the next Federal Reserve Chair. Warsh is widely seen as more hawkish than his predecessors, favoring a much smaller balance sheet, a return to scarce reserves, and less willingness to rely on quantitative easing in future downturns. Markets have responded with a pronounced steepening of the Treasury curve, as long-end yields in the 10 to 30-year area grind higher, while the front end remains relatively anchored. The dollar has strengthened and gold has pulled back, reflecting expectations for tighter policy, reduced balance sheet support, and a higher term premium, even as near-term rate cuts remain on the table in principle. Crucially, investors fear that a Warsh-led Fed may be slower to deploy aggressive market support in crises or could unwind it more quickly, eroding the perceived Fed put that has underpinned risk-taking for years. This is already feeding through into a short-term correction across risk assets, from equities and crypto to precious metals, and is particularly uncomfortable for high-multiple growth stocks and tight credit markets that have relied on ample liquidity. That said, the immediate market reaction has been modest rather than panicked, suggesting investors are still assessing how much of this hawkish stance will translate into actual policy, a tension that keeps this driver firmly in focus for the weeks ahead. The second major bearish driver is persistent inflation and fiscal expansion, which are together complicating the outlook for easing. December producer prices surprised to the upside, with headline PPI rising around 0.5% on the month and roughly 3% year-over-year, while core PPI jumped even more, led by stronger services inflation that runs counter to recent reassurances from the Fed. On top of that, short-term AI investment is lifting energy demand and pushing electricity prices higher, adding another layer of cost pressure for both infrastructure providers and households. At the same time, global fiscal expansion is intensifying, with governments increasingly comfortable with large-scale spending and widening deficits, a mix that stirs concern about long-term inflation risk and pushes long-duration bond yields toward levels that many investors view as a danger zone. This backdrop is encouraging markets to price policy rates as higher for longer and to pare back expectations for aggressive rate cuts, which weighs on duration-sensitive assets, speculative growth names, and richly valued credit. There is a counterargument, however. Some analysts see current inflation readings as overstated due to quirks in how housing and portfolio services are measured, suggesting that underlying inflation may already be closer to the Fed's target. The unresolved debate over where true inflation sits keeps uncertainty high and makes incoming data especially important for sentiment. The third bearish driver is political and geopolitical policy risk, which is amplifying volatility around an already complex macro backdrop. Investigations involving the Federal Reserve, delayed Senate approval of key nominees, and threats from lawmakers to block the next chair until legal cases are resolved all raise doubts about central bank independence and the clarity of future policy. Domestically, a tentative deal to avoid a full government shutdown still leaves important agencies with only short-term funding, and a brief partial shutdown is now seen as likely, underscoring fiscal dysfunction. On the trade front, renewed tariff threats toward Canada add to lingering concerns that protectionist measures could re-emerge and complicate cross-border supply chains, particularly in sensitive sectors such as aerospace. Geopolitically, accelerated U.S. naval deployments in the Middle East and the potential for escalation with Iran are another source of risk, especially for energy markets. While defense budgets enjoy broad political support and provide a tailwind for parts of the sector, the combination of geopolitical tension, policy uncertainty, and the prospect of a contentious Fed chair confirmation process raises the odds of policy mistakes and sharp, event-driven swings in asset prices. On the bullish side, AI-driven growth and earnings momentum remain a powerful counterweight to these macro headwinds. Memory and storage providers report structural shifts in demand, with exabyte growth expected to compound at roughly 25% annually over the coming years and order books effectively sold out for 2026, supported by long-term contracts with major cloud and AI players. Individual companies are reinforcing this narrative. SanDisk has surged on AI-related memory demand and multi-year agreements. Meta has delivered an earnings beat with improving monetization, and Tesla is committing around $20 billion of capital expenditure toward AI infrastructure and robo-taxis. Even in cases where share prices have wobbled, such as recent pressure on parts of big tech and European software, investor focus remains firmly on how effectively these firms can monetize AI over the medium term. This AI capex wave spills over into other sectors, boosting prospects for semiconductors, data centers, power providers, and even traditional energy firms that are signing large-scale gas supply deals to power dedicated energy parks for data centers. However, the same investments can drive higher input costs and have already contributed to a rise in electricity prices, while rich valuations and tight credit spreads introduce more downside sensitivity if growth expectations are disappointed. The result is a powerful but more volatile growth engine that continues to attract capital, even as investors grow choosier about balance sheet strength and execution. Another important bullish driver is the strength of European banks and Spanish growth, which is drawing renewed global interest. European financials have been key contributors to the region's equity rally, with sector outperformance supported by robust earnings and improving investor perception of Europe as attractively valued and less risky than the United States. CaixaBank stands out, having delivered about a 90% stock gain and now raising its medium-term return on tangible equity target to around 20%, alongside plans for a 15% increase in dividends and ongoing buybacks. These moves rest on solid capital generation, strong asset quality, and healthy loan and deposit growth in Spain and Portugal, underpinned by an economic outlook that sees Spanish GDP growing near 3% before easing only modestly thereafter. This combination of earnings visibility, income generation, and perceived macro resilience is encouraging a rotation toward European banks and away from some of the more crowded U.S. growth trades. While pockets of European markets, such as basic resources and energy, have underperformed, the banking sector's stability and profitability provide a genuine diversification option that can help offset volatility elsewhere in global portfolios. The final bullish driver is the prospect of Fed cuts later, which continues to anchor medium-term risk appetite despite near-term hawkish noise. FOMC participants broadly agree that the next move in policy rates is likely to be a cut, and market consensus still anticipates 1 or 2 reductions in the second half of the year, even as expectations for aggressive early easing have been scaled back. Macro data offer some justification for eventual easing. Unemployment remains below 4.5% while inflation hovers near 3%, suggesting substantial progress toward the Fed's goals. Evidence of labor market slack, including longer job searches and weakness among younger and highly educated workers, argues that conditions are not overly tight, and some analysts contend that measurement quirks may already be overstating true inflation relative to the target. Markets also recognize that a more hawkish Fed leadership could still become dovish at the front end if inflation data cooperate, even as long-end yields stay elevated. The risk, of course, is that persistent inflation or renewed fiscal and political pressure forces policymakers to delay or downsize cuts, and any wholesale removal of expected second-half easing could push yields and the dollar sharply higher. For now, though, the expectation of some eventual relief in policy rates provides a key offset to today's more defensive tone. To sum up, risk sentiment is cautiously risk-off as investors digest the prospect of a more hawkish Fed chair, sticky inflation, and rising political and geopolitical uncertainty, even while AI-driven growth and European banking strength keep a meaningful floor under risk appetite. The tug-of-war between tighter policy and powerful structural growth stories is likely to keep volatility elevated and market leadership rotating, making policy headlines, inflation data, and earnings guidance especially important in the weeks ahead. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.